This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
So welcome to the Financial Standard podcast. I'm Andrew McKean and speaking with Vanguard senior economist Alexis Gray. Welcome, Alexa.
Hi, thanks for having me, Andy.
We just wanted to start with, if you could provide us with an overview of current domestic economic conditions and Australia's market outlook in 2023.
The big news story of 2022 was that we had a surprise resurgence of inflation. And as a result, we saw central banks raising interest rates very quickly. And that's not something that a lot of people saw coming. Even the Reserve Bank governor was talking not that long before the start of the year about not raising rates until 2024. So that was the big shock of the year. And as interest rates have risen over the course of the year, we've seen the economy slow down. So it's quite clear that higher interest rates are starting to bite in Australia. For example, house prices have fallen by more than 8% nationally. Consumer confidence is quite weak. We're seeing retail sales trending lower. So the economy has kind of ended the year in a weaker spot than where it started. I think post-pandemic, the economy was booming and now that's kind of softened. Looking ahead to 2023, I think that higher rates will mean that the economy slows even further. So we're penciling in for the cash rate to rise to around 3.85%, which implies a few more interest rate hikes early in the year. And hopefully then the RBA is done and that will help bring inflation down slowly over the next 12 to 24 months. And so, but as a consequence, of course, of having those higher interest rates, that economic growth is going to slow. We expect GDP growth of around 1.25%, and that the risk of a recession is more elevated than normal. So I think it's going to be a more challenging year than what we saw last year. In terms of what's happened in the markets, I think the markets have really reflected what's happened in the economy, which is that it's been a tumultuous few years. It's been very difficult to price assets. So we've seen a lot of volatility, not only in the equity market, which is pretty normal to see some volatility, but also in the bond market where investors typically expect a steady stream of returns, and that really hasn't been the case. So the challenge for last year was that we saw contractions in both the equity and bond markets at the same time, which was painful, particularly for retirees who rely on a stable income stream from bonds. And so the market ended the year with valuations lower, although over the last few weeks we've seen somewhat of a recovery, which is good news. But I think looking ahead, given that valuations are now lower, they're more attractive in our view. That is a positive sign for the long run. We've actually upgraded our return outlook for equities and for bonds. And so we're now expecting that over the next decade, that in the equity market returns will be somewhere between 4 and 7% for Australian and global equities, annualized on a nominal basis, and for fixed income slightly lower at around 4 to 5% over the next decade. And that's better than where they were. That's an increase of around 200 basis points relative to a year ago. So that's the silver lining. A difficult year for markets means valuations are more attractive and the outlook has improved.
And what are some of the long-term implications of recent fiscal policy decisions on the Australian economy?
Yeah, during the pandemic, we saw unprecedented government spending. We saw the government trying to look after businesses and households by providing support in various ways, including things like the JobKeeper program. And so that was costly. We've seen debt levels rise. The government's now in a mode of trying to repair the budget over the coming years, trying to keep debt levels down as much as possible. So the deficit now is going to be smaller over the next several years. And the government, I think, is acutely aware that now is the time to repair the budget in case we have, for whatever else is coming down the road. And that's positive news. But of course, if the government is not spending to the same extent, that also means that the economy is likely to slow. So lower government spending implies that GDP growth is not boosted to the extent that it was. So that's, I guess, the challenge over coming years is that a tighter budget is going to be a little bit more challenging for the economic outlook. Another big policy decision recently was a decision to cap energy prices, which I think for households is positive news and is a relief at a time when inflation is so high. Cost of living pressures are really biting. And so I think that's good news that we're all going to get a bit of relief on the energy price front, at least for the next 12 months.
And taking into account what you've just said, what's the likelihood of Australia falling into a recession in the next 12 months?
Yeah, I mean, the risk of recession, unfortunately, is higher than normal because we're in a high inflation and high interest rate environment. And so we put the risk of recession at around 40%. So it's pretty close to a coin flip at this point. It's not our base case, but we're concerned that we may have a recession this year. And we certainly see the risk of recession as very high in other parts of the world, particularly in the UK, the Euro area, those parts of Western Europe that are very close to the Ukraine conflict and who now have sanctions on Russia, which is leading to very high energy prices. The US as well is in a kind of similar position with a very high risk of recession this year. I think Australia is fortunately in a slightly better position that we are a net exporter of energy. And so for us, there is some benefit, in fact, to the very high energy prices of recent years. We also haven't had the same inflation levels that have been seen in the US and Western Europe. So inflation here still is below 8%. And not only that, but we're a close trading partner of China, who've just exited zero COVID policy and who are on the cusp of a big economic recovery. And that should also provide a bit of a tailwind for Australia, which is good timing when the rest of the world is looking a little bit weaker.
And should investment managers consider significant portfolio adjustments to weather a potential recession, or should they stay the course?
Well, I wouldn't be a very good Vanguard ambassador if I wasn't promoting staying the course. That's one of our core investment philosophies that, staying invested through different market cycles benefits investors because timing the market is extremely difficult. I mean, we are professional investors and we have, large active investors on the team here at Vanguard, but even for us, it's challenging. Markets are pretty good at pricing in what's happening in the world. And so that's why, for the most part, I think buying and holding your portfolio and really setting your investment strategy based on your long-term investment goals. So those big decisions about how much of your portfolio you want to invest across the different asset classes, those decisions should be based on your personal investment goals and your risk appetite rather than what's happening in the market. And I think what's important to say as well is that, yes, it's possible that there will be a recession in Australia this year, but to some extent that's already partly priced into the market. We've already seen a weak performance in the equity market in anticipation of higher recession risks. Markets move very quickly to price in new information, and you have to be ahead of that information in order to really profit in the market. So I think there's a benefit to sticking to your strategic asset allocation that you set in the past with either with your advisor or that you've helped set yourself, and sticking with that through whatever market conditions come, whether that be a recession or not.
And looking abroad, could you give us a brief rundown of your current economic outlooks for North America, Europe and Asia?
Sure. I mean, the economic environment is more challenging in those regions than in Australia at the moment. So I mentioned earlier that we, pencil in a very high risk of recession in the US, UK and the Euro area. It's highly likely that we'll see a recession, particularly in those Western European countries because of their proximity to the Ukraine crisis. And so we're actually penciling in GDP growth to contract by around 1% in the UK and Euro area. In the US, we're penciling in positive growth, but only slightly above zero at around 0.5%. So that's a pretty tough year for the economy. That is in large part due to this shock of the Ukraine crisis, very high energy prices, very high inflation, but higher interest rates will help bring down that inflation. And so the positive news is that over the course of this year, we expect inflation to fall from its peak and be well on its way back to central bank targets. So that's, I guess, the silver lining of a more challenging year for those countries.
And how should financial advisors navigate current economic conditions in their clients' investment strategies?
Well, I think one of the most important things is to have realistic discussions with clients about the economic environment. So, obviously none of us can control what happens in the economy or in the markets. We can't control what happens to inflation or whether there are military conflicts in different parts of the world. But what you can control is setting a reasonable expectation about what your portfolio might achieve and what inflation levels we might see over coming years. And so in terms of setting expectations, I mentioned previously our forecast for equities and bonds. So for equities, our return forecasts are around 4 to 7% over the next 10 years. And for bonds, it's around about 4 to 5%. So I think having a reasonable kind of median expectation and understanding, of course, that market conditions can fluctuate and there'll be years which are stronger or weaker, and that inflation may be a little higher. I mean, it may take time for inflation to fall back to 2%. So an assumption that inflation may be 3 or 4% for the next couple of years is also a reasonable one, and that perhaps maybe it's a time to be belt tightening and perhaps trying to keep those balances as high as possible and not spending them down too quickly in anticipation for a market recovery. I think that's a kind of prudent way to approach the market over the next several years.
Fantastic. Thanks so much for your time, Alexis.
Cheers. Thank you.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.